think so. It's all about trade. Will tariffs be put on? Will tariffs not be put on? Will we get a deal? Everyone's acting as if a deal is minutes away. If the deal doesn't come through, I think the equity market starts to roll over. If the deal does come through, I think we have an initial pop, but then we kind of go sideways after that because it's hard to beat expectations. As you point out, we've been talking about a trade deal for a long, long time.
What does rollover mean? What does that look like?
So I think you probably have a 2, maybe 3% pullback in the equity market. Nothing catastrophic, but something reasonable.
So we're all, I mean, again, we ask this question a lot. Are we fully already valuing the benefit of a trade deal in the market?
David, I think we are. So our opinion is our price target has been 38. We're about 2% above that. And what we've been saying is the risk reward just doesn't make all that much sense because what are you playing for at this point in time? The deal really has to be above expectations for the market to pop and have a sustained rally after that. And I just don't think that's possible in the short term. The other issue, as we know, is Trump has pushed his bets when the market has been higher and sentiment has been rather good. And so that probability is out there, and that's why we're worried about the risk reward.
Yeah. Barry, if I told you at the beginning of the year we were going to be up over 25% in the S&P, I don't know if you would have believed me, but we are. Are we going to maintain those gains for the full year?
Yeah, it's remarkable. I mean, October 2nd is when we really rotated up on the market. We've gone up 9% on the S&P 500 since October 2. I mean, in a typical year, 9% price, 2% dividend, that's a full year return. So it's been huge. The other thing is, when you look at it, technology, healthcare, financials, and communication services are doing very well. When you've got growth and value working together, that's a sign of a bull trend. The third thing I would say is that money supply growth using M2 is up at a 10% annualized rate the last 3 months. It's more than 2.5 times what you would expect nominal GDP to be this quarter. So when you think about that, that's excess liquidity for the stock market. I just don't want to stand in the way of the freight train.
So, Barry, you've got utilities and real estate higher today in what's a down market, although only modestly down. But they're the worst performing sectors. They're both negative for the month of November. I mean, we've been talking about this rotation that we're seeing in the market. Is it sustainable? Does it continue? And do you buy into it?
We had been overweight, significantly overweight, and recommending utilities, staples, and real estate for the year up until October 13th. And over that weekend, we decided to rotate into a pro-cyclical stance. I would like to see, for the sustainability of the economic cycle, a pullback in the dollar on better global growth abroad. And I would like to see a higher 10-year yield, a more steep curve than what we've seen so far. So those are the two things we'll be watching besides trade as we go into the end of the year and next year.
Chris, it's hard not to forget what happened last December, however. I mean, we didn't have that 25% gain going into Thanksgiving last year, but, you know, there were a variety of kind of technical factors that really led to some significant volatility, some significant losses. Is there a risk of that actually repeating this year? Have those technical factors gone away?
Leslie, I think that's kind of tough. And I think one of the reasons why we're up so much is everyone was afraid of last year. So they were positioned very defensively. They weren't very long. They weren't over risk. And now we're starting to see that grind higher as people kind of miss the market and there's FOMO out there. Everyone has fear of missing out at this point in time. So the answer is I find it highly, highly unusual if we saw something very similar to last year. I think we continue to grind higher, but we do think that you want to start slowly taking profits here.
Yeah, Barry, to that point, I mean, a year ago you had a Fed that was tightening. This year you have a Fed that's been easing over the last couple of months as well. So how contingent is this market on Fed policy?
Yeah, a year ago, around this time, we were very concerned with the Fed. I mean, they were ignoring the fact that they were approaching the neutral rate, and we were able to show that just being near neutral was too tight. They had also continued with the quantitative tightening, and we saw with the repo blow up that was just a mistake to continue all the way into 2019. But the Fed we hit the Fed's pinch point in the fourth quarter, and they've been easing ever since. I think the Fed's done its part, but I would say that if you don't get relief on trade, some sort of a trade deal or armed truce, we would lose some of these gains we've had since October.
So you agree, Chris, that trade is connected to a certain extent to rates as well?
I think absolutely it's connected. We heard that from the Fed, that they were worried about global recession, not so much global recession, but global stresses. And Trump did a very good job at pressing his bets. He did a very good job at putting uncertainty in the marketplace, and the Fed did react to that. So the answer is yes.